What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we're going to be looking at a recent article that Ray Dalio wrote discussing whether we have a stock market bubble right now or not. We're going to look at some of the charts that he's put together that will indicate if we have a stock market bubble right now. What are some of the input sources that are coming into these charts to indicate whether or not there's a bubble right now, and if so, what to do about it. Ready? Let's dive in. All right, so if you're not familiar with Ray Dalio is the founder of the largest hedge fund in the world, Bridgewater, and he puts out a lot of fantastic research. He's written multiple books. My favorite book by him is Navigating Big Debt Crises. That's a fantastic book by him. I highly recommend it. And so there's really six. Well, first of all, how does Ray Dalio define a bubble? What he means when Ray Dalio says bubble, he means an unsustainably high price. And so there's six measures that Bridgewater and he looks at in order to determine whether something is in a bubble or not. So the first one here is how high are prices relative to traditional measures. So look back at the traditional measures of valuations and pricing, and how high are they versus traditional measures, not current measures. That's important. Number two, how are prices discounting unsustainable conditions? So look at the prices, and are the prices factoring in continuation into the future of something that actually can't continue? Number three, how many new buyers have entered the market? And by new buyers, it means those who were not previously in the market. Because if the market has absorbed a ton of new buyers, let's say every single person in the world has invested all their money in the stock market. Well, that's the top, right? You can't go up from there. There's no additional money to come in. Number four, how broadly bullish is sentiment? So that's a sentiment gauge. You just look around, whether it's, with, depending on how you measure this, you're just looking around and seeing the average person, the average investor, the average company, how bullish are they? How much do they expect things to continue to go up? Number five, are purchases being financed by high leverage? And so again, that's fairly self-explanatory. Is there a lot of debt being used or other forms of leverage, such as derivatives like options, in order to make purchases? And then lastly, have buyers made exceptionally extended forward purchases, which is built inventory, contracted forward purchases, to speculate or protect themselves against future price gains? So these are the six measures that are looked at to determine whether a stock market or something is experiencing bubble dynamics. Now, if we look at their output, and you take the answers to all these questions and you look at the stock market historically today versus the 20s, versus the dot-com bubble, versus 2007, take a look at this chart. You can see here that during the 20s, the bubble indicator hit all the way at the highest possible it could, hit bubble on all six of those except the last one, buyers or businesses making extended forward purchases, which was frothy, which is just down from bubble. During the dot-com bubble, it was all six across the board. The indicators were flashing bubble on all fronts. During 2007, this is important because during 2007, right, we had a crash following that. Maybe not immediately, but there was a crash following that. And in 2007, these indicators did not all turn up bubble. When you look at traditional measures of valuation, when you look at prices discounting unsustainable conditions, the stock market was not flashing bubble signs at that point. Maybe the housing market was, but the stock market was not. Things like whether new buyers have entered the market, broad bullish sentiment, those were frothy. And then the last two were flashing bubble indicators. Purchases were being financed by high leverage, and forward purchases were being made. Now, when you look at today, the market is fragmented. So there are what Ray Dalio and Bridgewater's research is pointing to is that there are certain areas of the market that are flashing big bubble signs, and then certain areas of the market that are not. Case in point, tech, and specifically emerging tech, showing a lot of bubble signs right now. So the top two, traditional valuation measures and discounting unsustainable conditions, those are showing frothy. When you look at new buyers entering the market, obviously that's bubble, right? You can see in a lot of stocks, they're being purchased by basically all by retail, especially those who are brand new to the market. There's a lot of stocks that are extremely concentrated in the hands of the small retail investor, just brand new entrants into the market, especially after COVID. Broad bullish sentiment in certain stocks, very bubbly. Purchases being financed by high leverage, very bubbly. And then somewhat frothy are going to be businesses making extended forward purchases. Now, the rest of the market is not flashing those same indicators. In fact, based on their proprietary data and indicators here, there's no bubble signs being flashed anywhere in the stock market right now outside of these isolated companies in emerging tech. So the highest bubble indicator that we get here is going to be frothy with new buyers entering the market and broad bullish sentiment. Everything else is not there yet. So if we look at the next chart here, we can see that in aggregate, we're getting up to the 77th percentile today. When you look at the entire stock market, we're up there in terms of, how bubbly the market looks, but we're not anywhere near before the Great Depression. We're not anywhere near the dotcom bubble burst yet. Now, the fragmentation in the markets that's going on here, where you see a lot of, bubbliness going on, a lot of overvalued, but these bubble indicators are flashing strong bubble signs in certain stocks, but not in the broad market. That's highlighted when you look at these emerging tech stocks versus the S&P 500 over the last year, maybe a little over a year. Returns since the start of 2020. So if you look at the S&P 500, the top 500 stocks, you can see that the blue line there is the return, and then the red line is the return for these companies that are flashing bubble signs. And so you can see there that they've vastly outperformed the rest of the stock market. Now, let's break it down into those 6 indicators. Let's look at the first one first. How high are prices relative to traditional measures? We look at this, we're at about 82nd percentile here. So just looking at this first metric on, whether the market is flashing a bubble sign, again, we're up there, but we're not, we're not at the peak. We're not at those extremes that we've seen before within the last 100 years. The second indicator, are prices discounting unsustainable conditions? Again, we're in the 77th percentile here. So it's high, but it's not, again, anywhere near where it's gotten to multiple times in the past century. Now, the third indicator, this is where we're seeing it kind of peak out here, and this is the new buyers entering the market. And so that kind of makes sense, right? We're in the 95th percentile, and that is very, very high historically. We've got a flood of new investors coming into the market over the last year. Bridgewater has their for the fourth indicator, broadly bullish sentiment. How broadly bullish is sentiment? Currently sitting at 85%, and one of the reasons for this is because of IPOs. IPOs are they're coming on hot right now. Lots of IPOs, lots of new companies going public. That's typically one of the signs of right before there's going to be some sort of crash. You usually have a spike in IPOs, and obviously that's being led by SPACs. It's much easier for a company to go public through SPACs, special purpose acquisition companies. There's a lot less red tape for a company to be able to go public through one of these deals. So we're seeing a lot of that happen through SPACs right now, which is contributing to the spike in IPOs that we're seeing. Now, the fifth indicator, are purchases being financed by high leverage. We can see here that the USA leverage gauge percentile that they have there, currently sitting a little under 80%, nowhere near the dot-com bubble. But there's a lot of leverage through the use of options, specifically call options on single stocks. That's at record highs, driven mainly by retail purchases. And so you can see here on this chart, call volume versus put volume, the divergence is big compared to the historical correlation there. We've had a lot higher buying of calls than we've had of puts over the last year or so. Now, this last one is kind of what's keeping down the entire bubble index. If you look at everything aggregated together, this one is, to what extent have buyers made exceptionally extended forward purchases, which is done primarily through CapEx and M&A. And you're not seeing a lot of this right now. If you look at what's the percentage on this? It's down at, it's under 20% right now, maybe 15%. And this is arguably one of the biggest drivers of kind of bringing a bubble to completion, if you will. You always see a lot of this kind of stuff. You always see a lot of corporate spending. You always see a lot of this kind of stuff happen right at the end, right at the height of these bubbles. So what's my takeaway from this? my takeaway from this is essentially that we are getting into the top of, we're getting into this blow off top area where we're starting to see some of these bubble indicators flash in parts of the market, but it's not, in terms of the stock market, it's not flashing strong everywhere yet. And that's important because that means there's still dry powder left to be burned. And so especially this last one, this holding down the entire index, once corporations start plunging money into this, that's really going to start driving prices up. And that's kind of this blow off top, this melt up that, it looks like these indicators are saying could be coming, because you don't see these indicators. These are more long-term view things. And so you're not going to see them predict the exact timing of tops or bottoms. And so it looks like there's some remaining fuel in the fire, which should push everything to kind of this blow off top, which is, you're seeing kind of a similar approach, a similar expectation in the market being looked at from different analysts, different economists, for completely different reasons. That's one of the things I like about looking at things from different points of views, is because, hey, if you've got people who disagree on how things happen, or their views on economics or anything like that, but they're all kind of saying, hey, it looks like the same result is going to happen, then you're able to kind of start to isolate the signal from the noise there and start to see something that is, a common theme spread throughout. So that's kind of my takeaway from this. And if you have any questions and that you'd like to ask me directly, keep in mind I do a monthly live stream Q&A for members only. Go ahead and hit that join button next to the subscribe button below the video. If you don't see it there, you can always sign up through the join link in the description below. $25 a month, members only. These Q&As are never posted publicly. They're only posted after the fact for members only. So I do that once a month. If you're interested in getting very specific questions asked about the market or portfolio allocation or anything like that, go ahead and sign up there. As always, let me know what you think about this in the comment section below, and I really appreciate you watching. Have a good day.